The phenomenon of crowding out is one of the key things to understand in accounts of public spending. Ultimately, there's only a certain amount of investment capital around. To the extent that the government is using that money, whether for investment or for current spending, it's not available to other people. So if the government sells lots and lots of bonds to private investors and uses the money it gets from selling the bonds to fund its current spending, those private investors are not investing in other kinds of economic activity, which might well be more productive than investing in government debt, given that the government activity might not be very productive. The question of whether or not government money is always going to be less productive than private spending is ultimately an empirical one. We can say that in principle we would expect this to be the case. That's because, generally speaking, if you're spending your own money on yourself, you're going to do it very carefully. If you're spending somebody else's money on yourself, you're also going to be reasonably careful about it. However, if you're spending somebody else's money on somebody else, which is what is the case with governments, then you have no real incentive to use that money effectively or efficiently. And there are many, many examples from history that bear this out. There is a case for saying that there are certain kinds of spending which are more efficient when carried out by government because of the economies of scale that government possesses. However, this is almost always outweighed, and I would argue in fact always outweighed, by the huge inefficiency costs that come with the less productive public management and the fact that public provision does not face the profits and loss incentives which lead private providers to constantly look to improve the quality of their service and cut out waste and unnecessary costs.